The two things you worry about and have your eye on are the trade wars or potential trade wars and the strength of the economy and what we know about it. As far as the trade wars, things got ramped up. So now you're not convinced we get a near-term resolution. And as far as the economy goes, while we've got some great numbers like GDP and unemployment, we've got some ones that make you wonder, like consumer, like retail and things like that. So you think it's time to go, what, equal weight instead of overweight?
We're basically around equal weight, maybe just slightly overweight. But the way I think about the trade, we don't have no idea what's going to happen with the trade war, and I don't think anybody else does either. But just a couple of weeks ago, we thought, and most people did, that there was going to be a deal, and we're down a few percent since then. But if talks completely collapse and we go into a full-blown trade war, I think that the market could fall by 10% or more. So given that the upside to get back to where we were a few weeks ago is maybe a few percent and there's greater downside, I think the prudent thing to do is to pull in risk a little bit here.
You, I'm sure, have some empathy for Ed's position at this point, Phil, but I think you think things will, but you're more optimistic things get resolved.
Well, we think that both China and the United States are motivated to get this deal done. Now, we absolutely concede that the volatility in the market that's going on right now is being driven by the uncertainty over China. But we think this G20 meeting in Osaka at the end of June is we've got 6 weeks here to try to get something done. The United States needs a deal. China, I think, needs a deal more than we do in terms of how slow their economic growth was last year, the slowest growth in 28 years. The Shanghai index down last year 32% or so. They want to be able to remove these tariffs and get free and open trade and get their economy and markets going again. So I think to some degree you've got negotiating stances, an elaborate kabuki dance, if you will. But we think when the dust settles, we'll get this deal done.
We've got the way that it's covered, too, is pretty good. Because, on Tuesday, the trillion has a lot of zeros. It's very, for an on-air graphic, it's a very compelling thing. I mean, Trump tariff losses, 1 trillion. Now, we've come back a trillion, basically, since Monday. I haven't seen that this morning. I don't know if we're going to bring that up. I don't know if we're going to use the same metric. But certainly at this point, for being, 2% off the all-time highs? For being 2% off the all-time highs, we certainly are aware of potential potholes, are we not, Ed? I mean, that's why. I mean, who's not aware of what you're saying right here? And why doesn't that make you think you should maybe?
That's right. It's not as though that we have some great insight into what's going to happen with China's negotiators or U.S. negotiators. I just think it's a question of balancing risk and reward. And so if you go back to where you were, where it was widely expected you're going to deal, you're going to go back to the price you had a couple weeks ago, just up 2%. But what we don't know is what's the odds that negotiations fail. Now, I have no idea what those odds are, but they've got to be greater than they were a couple of weeks ago. So it's just a quantitative balancing of risk and expected return. And I think, we may be wrong, and maybe things will go to new highs pretty soon, but I think the possibility is greater now that things could go.
You don't think, so you think it's a greater possibility that we don't go to new highs in the next 3 months than maybe we retrench to where? We had the guy at UBS is 25.50 now, and I guess he's speaking for all of UBS. Where, I 25.50. I said, so I'm going to tell my people at UBS I need to sell everything. We don't own things, but
yeah, we're not bears, right? So we still think that the best economic news we've had in a long time is that productivity growth is finally starting to get some traction. And if that turns out to be the big story of the next several years, as some people believe, then that creates a great bullish backdrop. But in the short run, given this new uncertainty, I think the prudent thing to do is just to take a little chip off the table and play a little cautious.
Joe, I saw that interview you did the other day with Francois over at UBS. And the two issues that I think UBS is ignoring here is that inflation and interest rates are still relatively benign. So multiples ought to continue to expand, in our view, back to that 18.5 times neighborhood. And we do not expect that this China deal is going to result in a recession. Slower growth, maybe corporate earnings growth of only 5 or 6% this year. We're looking at $170. But if we get that 18 multiple with $170 in earnings, which we think are reasonable estimates, then we're talking about a 3,100 estimate for the S&P at the end of the year, not 2350 or whatever their forecast was. So if you focus on the underlying fundamentals and have a reasonably constructive view of where we are in this China-U.S. negotiation, you've got to conclude that this is an air pocket. It's healthy. It's a correction. We'll wash out some weak hands. But eventually we'll get this ship righted and work higher by the end of the year.